Hello, everyone. This is Justin Smythe from nextbigtrade.com. This is your weekly index review for April 12th, 2024. Starting off with the S&P 500, you can see in the chart the S&P 500 was down 1.56% for the week. Notably, on the weekly chart, the S&P 500 has now given back all the gains from the movement out of the Fed interest rate news a couple of weeks ago. So the Fed came out and said they might cut interest rates a couple times this year, and that initially moved the market higher, but the volume again was on the low side, and we've been talking about how there's been a lack of volume for weeks now in this stock market. And then selling pressure came back in last week. If you remember, there was a notable day on Thursday where the market reversed quite significantly and sold off last week. Then this week we had two notable moves on the downside, one on Wednesday and one on Friday. The Wednesday move was after the CPI report, where the market really tanked aggressively to the downside after the inflation news. So overall, the market is now down 2 weeks in a row. We're finally retesting the 10-week moving average for the first time since this stock market rally out of the October lows from 2023 started. And I think the weight of the evidence suggests that we're heading into the first major correction of the year. Moving over to the daily chart, we can see the S&P 500 is starting to live below the 20-day exponential moving average. If you look at the timing model document, which is on the website, I added a trend indicator to the timing model, which basically allows the timing model to kind of filter out markets that are being driven by mega cap or large cap stocks, which is what this market's really done for most of this year. Most of this rally, especially since the start of January, really has been led by large and mega cap technology stocks. So initially, coming out of the October 2023 lows, there was an explosion in breadth and lots of stocks participated. And then if you look at a lot of charts since about the start of January this year, which is this arrow right here, breadth really starts to deteriorate, and less stocks participated during this entire rally. There was a couple of big winners like Nvidia, SMCI, but there really wasn't a proliferation of winning stocks during this entire time period. But the market was still moving higher because it was being driven by these large cap stocks. So now the market's finally deteriorating below the moving average, and there was a couple closes below the moving average last week. So we're finally getting a breakdown after such a long rally, and even the larger cap stocks are starting to come under pressure a little bit now. You can see on the daily volume, again, most of the heavier volume days recently have been selling days, which again indicates more distribution in the market, and we really haven't had a ton of buying pressure since the quad witching day, which was this big volume spike here on March 15th. So ever since then, you can see how the volume just kind of gone down. There's not a lot of buying pressure, and the market's slowly starting to roll over. So that's what's still going on with this market on the daily chart. The one thing that did, again, save this market last week was large cap technology, which was only down 0.5% last week. And there was a couple mega cap tech stocks, Apple and Tesla, that actually were up last week. These are two mega caps that have been down this year, so they basically had bounces last week. But we'll see if that can continue heading into next week. So the NASDAQ 100's actually now in the best position of some of these major indices. You see the relative strengths actually curled back up a little bit. And it's left to be seen kind of, whether we're going to break out and maybe make one more new high here or whether we're going to get some more weakness. But overall, the weight of the evidence is suggesting that the bears really have control of this market. Apple was the one stock that did bounce last week, and the volume actually picked up towards the end of the week. So this is going to be an interesting stock to watch heading into next week, where we just retested the 10-week moving average once again, and we're basically set up. We're in stage 3 right now. We kind of had a breakdown below the 30-week moving average. Now we're retesting the 10-week back to the upside. If this area is found as resistance and we get a rollover, that's a bad sign for the stock market, especially with Apple being one of the biggest stocks in the stock market. So important stock to watch heading into next week. We'll see if it can actually add to this little bounce move or whether it just, peters out. The NASDAQ composite, again, was actually down less than the NASDAQ 100, so a little bit of strength in technology, although, the selling pressure, there's still a little bit of above average volume here. It'd be better if the volume was drying up, but we're still kind of above the 10-week moving average as well. So we'll see if technology can bounce next week. And then the indices that don't have large components of technology were hit the most again this week for 2 weeks in a row. The Dow was down over 2%. The Dow lost the 10-week moving average, and you've got a failed breakout after the Fed move here, and it's continued lower, below the 10-week moving average. Notice the volume is above average on the Dow. The Dow has a lot of financials and consumer cyclical stocks, and financials started getting hit hard this week as well. And we'll go over the JP Morgan move, especially because that's a significant move for the market. Largest bank stock was under significant pressure after earnings on Friday. So big time weakness for this index that doesn't have a lot of technology components. The same thing for the Russell 2000. Even more carnage for the Russell 2000, down almost 3% for the week on above average volume. Again, the Russell has lagged during this entire stock market rally, and the idea that the Russell would start leading has just not materialized. This again, leads to the idea that we are now in a correction, especially if the Russell continues to roll over next week. We've got a failed breakout setting up here in the Russell 2000 and the small caps. Small caps are also comprised of a lot of regional banks, and again, these financials are now coming under pressure again. Turning to stock market breadth, this was one of the biggest, most important moves in the market this week. Was massive deterioration in the number of stocks above the 50-day moving average in the S&P 500. Actually, last week was the biggest move lower in this indicator for quite a while, and then this move this week was just exceptional weakness. And really what happened here is, a lot of stocks over the last 3 to 4 weeks have been catching back up to the 50-day moving average as the market's just kind of grinded sideways and barely stayed, in an uptrend. And then once all these stocks that have caught back up to their moving average came under pressure again, they all started rolling over below the moving average at the same time, and that has led to a massive drop in the percentage of stocks above that moving average. So it's kind of like a stage 3 into stage 4 type of behavior where you got this topping action, the price is catching back up to the moving average, and then now we're starting to roll over. And that's actually the opposite of what happened, when the market came out of this correction, is you had a lot of stocks, showing a little bit of strength down here and, catching back up to their 50-day moving average from the downside. And then all of a sudden when the market breaks out, breadth exploded to the upside and the rally started. So we're seeing the opposite here, deterioration leading into breadth rolling over. And ultimately what, we want to see for a major buy signal is these periods where the percentage of stocks above the 50-day moving average is below 20%. These are the best times to buy stocks every year in the stock market. And the last great one that we got was in October 2023. We could be setting up to get one of these great buying opportunities perhaps over the next month or two, after this correction finally plays itself out. So finally getting a little bit of a pullback here, and again, we still have to be patient. We could be setting up a great buying opportunity in the future here. The NASDAQ, again, we noticed, you talked about the deterioration, the divergence here that's just been going on for weeks and weeks and weeks. And then the NASDAQ breath rolls over again last week. Again, a lot of this market's being held up by large cap technology. And, the percentage of stocks is now just above 30% above the 50-day moving average, even though the NASDAQ composite is still above the 50-day moving average itself. So really this speaks to just how significant the large caps have really held up this market. This is almost oversold, and we're still above the 50-day moving average in the NASDAQ composite. Finally, turning to the VIX, we continued the VIX breakout this week. We bounced off the 30-week moving average. As I noted in the shorting guide document, whenever the VIX trends above this 10-week moving average, is a good time to be short the stock market, and also playing these inverse ETFs to the long side. And obviously the UVXY ETF is taking massive volume too. So the last time we had the VIX explode higher was during that October correction. Now we're doing the same thing. We did come off the highs of the week a little bit, but as long as we stay above this moving average, that's really what's critical here. And once we start to make that parabolic top and then close below it, that would be a time to start looking for a bottom to this correction. So overall, we're still potentially early in this correction. We've got volatility heating up. We've got very few stocks breaking out, and this is a defensive market until things change and more corrective activity occurs.